Welcome to Griffonomics.
Glad to be here, diving into this one.
Yeah, it's a massive topic today because I want you to imagine, just for a second, waking up tomorrow and deciding to literally double the price of your core product overnight.
Right, which is usually a terrifying thought for any business owner.
Oh, absolutely. But imagine doing that and discovering that not only did none of your customers complain or, leave for a competitor, but your line of customers actually got longer.
It's the absolute dream scenario, really.
Right. I mean, you didn't spend an extra dime on marketing. You didn't build any new infrastructure.
No new factories, nothing.
Exactly. You didn't mix a single ounce of concrete. You literally just changed the price tag and bam, you doubled your revenue overnight.
Yeah, it's the purest, most unadulterated display of monopoly pricing power that you can really imagine in the modern market.
And that exact scenario, that incredible display of power, is what we are unpacking today.
It really is a fascinating case study, but,
Hmm.
it's also a scenario that comes with just intense scrutiny.
Oh, for sure.
Massive systemic risk, and honestly, a ticking clock. Because when you hold that much power, the entire ecosystem eventually tries to break you.
Yeah, nature abhors a vacuum and markets abhor a monopoly. So today is Tuesday, April 28th, 2026. And if you are listening to this, you are likely managing a massive institutional portfolio or, prepping for a high-stakes corporate strategy meeting.
Or maybe you're simply someone who relentlessly seeks to understand the invisible structural forces that actually govern the American economy.
Exactly. And if that's you, you are in the exact right place. Our mission for this deep dive is to conduct a really granular, unsparing strategic analysis and to build an investment roadmap for FICO.
Yes, Fair Isaac Corporation.
The credit score, guys. We are completely deconstructing FICO's transition from what has traditionally been a legacy credit scoring monopoly.
Well, old guard.
Yeah, into what is rapidly and honestly somewhat quietly becoming a high-growth, vertical SaaS powerhouse.
And to execute this mission today, we are relying on a very specific, freshly released stack of source material.
We're not just reading op-eds here.
Exactly. We are going straight to the raw data. We're analyzing FICO's Q2 2026 earnings transcripts, their latest financial press releases, some internal strategic investment memos, and their most recent, highly detailed investor presentations.
No hearsay, just the raw financial mechanics and the executive strategy. Because we really need to set the stage properly here. The tension at the heart of this company right now is just palpable.
It is. It's a company with a massive dual identity.
Right. If you stop someone on the street and ask them what FICO is, they'll tell you it's a 3-digit number.
Yeah, it's that inescapable shadow that just follows you around.
It totally is. Dictating your financial life, deciding whether you get the house, the car, the credit card, or, even an apartment lease these days.
But behind the scenes, far away from the consumer's eyes, FICO has evolved into something structurally massive.
They really have. They've become an inescapable financial toll bridge, essentially, for the entire American economy.
And right now, they're aggressively leveraging that toll bridge.
Harvesting just unprecedented amounts of cash.
Exactly. And they're using that cash to fund a massive structural pivot into artificial intelligence and cloud software.
It is arguably one of the most fascinating corporate evolutions happening in the market today, in my opinion.
Oh, without a doubt. You have this old world data monopoly acting as the financial engine to underwrite a completely new world technological dominance.
So, okay, let's unpack this. Let's start with that engine. Because to really understand where FICO is going with artificial intelligence, we first have to look at the sheer, undeniable financial gravity of their present situation.
Right, the reality on the ground today.
And that reality was just laid bare in their Q2 2026 earnings. When I was reading through the source materials, the numbers simply jumped off the page.
They were shocking to a lot of analysts.
We are looking at $692 million in revenue for the quarter.
Which is a 39% jump year over year.
Yeah, but the bottom line is what really demands attention here. A massive $12.50 in non-GAAP earnings per share.
A 60% year-over-year increase.
60%. When I see a mature, 70-year-old company suddenly posting 60% EPS growth, my first instinct is to look for the anomaly. Like, what are the actual mechanics behind that kind of sudden acceleration?
Well, to understand the mechanics of that 60% EPS growth, we really have to talk about a foundational economic concept, which is absolute inelasticity of demand.
Okay, lay that out for us.
So when economists say a product is inelastic, they mean that a company can raise the price of that product and consumers will continue to buy it in the exact same quantities.
Because they literally have to.
Exactly. Because there is absolutely no viable alternative, the product is structurally required. And FICO's classic score is the absolute textbook definition of this inelasticity.
It really is.
It is currently utilized by roughly 90% of the top lenders in the United States. It has been the absolute industry standard measure of consumer credit risk for over 35 years.
And it isn't just used at the point of sale, right? It's not just the guy at the bank desk. It's baked into the entire secondary market.
Precisely. That is the actual key to their moat. The score isn't just used by a bank teller to approve your credit card.
Right.
It is utilized in complex institutional underwriting, in pricing models, in mortgage insurance.
Investor credit risk models on Wall Street.
Exactly. In prepayment velocity models, in bank capital requirements, and in the ratings of multi-billion-dollar mortgage-backed securities.
It's everywhere.
It is the fundamental unit of measurement for American credit risk. It's the plumbing.
And because they own that plumbing, FICO possesses absolute, unadulterated monopoly pricing power.
And in Q2 2026, they decided to violently flex that power.
And flex they did.
Yeah.
I mean, if you dig into the scores segment of their earnings report, specifically the business-to-business or B2B scores revenue, it surged by 72% year over year.
Right.
And I want to be very clear for the listener here. That 72% surge is not from organic market expansion.
No, not at all.
That is the direct result of a deliberate, highly aggressive pricing action. The sources detail exactly what that action was.
They boldly raised the base price of their classic FICO score for mortgage originations.
From $4.95 per score to $10 flat.
They quite literally doubled the price overnight.
Yeah. And this is exactly where that inelasticity you mentioned comes into play.
Right, because think about the context of a mortgage transaction.
Yeah.
If you are a lender, the ultimate objective is closing a loan.
Getting the deal done.
Right. Let's use a very standard example, like a $400,000 mortgage. In the grand scheme of that transaction, the home buyer is already looking at thousands of dollars in closing costs.
Oh, yeah, it's a laundry list. You have title insurance, appraisal fees, origination fees.
Attorney fees, recording fees, all of it.
So in the context of a $400,000 asset transfer, what is an extra $5?
It's mathematically infinitesimal.
It's a roundinger.
Exactly.
Yeah.
Lenders essentially have no choice but to absorb it or pass it on because they literally cannot originate the loan and sell it to Fannie Mae or Freddie Mac without that FICO score.
The cost is simply too small to justify abandoning a massive transaction over it.
Right. It's a brilliant, almost ruthless capitalization on their structural market position.
But, I want to make sure we get the full economic picture straight here. Because usually, when a company aggressively doubles its prices, it's a defensive maneuver, right?
Often, yes.
You often assume they're doing it to mask a severe decline in actual product usage. Like, if fewer people are buying houses due to macroeconomic headwinds, a company might feel forced to charge more per house just to keep their top-line revenues from shrinking.
Right, you squeeze the remaining customers harder.
Exactly. But looking at the Q2 data, that is not what happened here at all.
No, it is the exact opposite scenario. And this is a really crucial nuance from the Q2 earnings call.
Yeah.
This massive revenue spike was not merely a price hike masking low volume. The actual volume of mortgage applications went up simultaneously.
Which is why
During this specific quarter, there was a temporary but significant drop in macroeconomic interest rate.
Right, rates dipped a bit.
And that led to a much better than expected uptick in mortgage origination volumes, both for new purchases and for refinancing.
So they essentially caught a massive compounding tailwind.
Exactly. They doubled the price of the ticket, and the line to get into the theater actually got longer.
The math on that compounding effect is just staggering. You take the higher volume of mortgage originations, you multiply it by the doubled unit price, and the result is what the earnings report shows.
A massive 127% year-over-year growth, specifically in mortgage origination revenues.
That single variable was the primary driver of their entire B2B revenue explosion. It really goes back to that toll bridge analogy we used earlier.
It does.
If you own the only bridge into a bustling economic hub, every commuter, every delivery truck has to use your infrastructure.
Right.
And if you wake up one morning and change the digital sign on the toll booth from $5 to $10, people might grumble. Loan officers might complain on LinkedIn.
Oh, they definitely complain.
But they are still going to drive to work. You've just doubled your revenue without taking on any additional capital expenditure.
Not at all.
But as an analyst, I have to push back on this thesis a little bit. No party lasts forever, right? And no monopoly operates in a complete vacuum. Is there a ceiling to this pricing power?
That is the multi-billion-dollar question that every institutional investor is currently modeling right now.
Right. Could FICO just raise the price to $50 next year or $100? Like, when does the elasticity finally snap?
Well, in pure economic theory, as long as the FICO fee remains a microscopic fraction of a percent of the total transaction value, the inelasticity should theoretically hold.
So even at 20 bucks.
Even if the score went to $20 on a $500,000 mortgage, it still barely registers on the massive closing disclosure document.
True.
However, the limit isn't necessarily economic, it is behavioral, and more importantly, it is regulatory.
Ah, right, the government.
Yeah. At a certain point, when you continuously squeeze an entire financial ecosystem, the participants in that ecosystem, the massive banks, the mortgage originators, they start actively looking for ways to break your monopoly.
They don't like being held hostage.
Exactly. They start heavily funding alternative models. And the federal regulators start paying very close attention to whether you are acting as an illegal tax on the system.
Right. If the toll gets too high, the city council eventually steps in and threatens to build a second bridge.
Precisely.
We're going to dive deeply into the regulators and the specific competitors trying to break this monopoly in just a moment. But first, I want to follow the logical progression of FICO's strategy.
Okay.
Because while they are happily harvesting massive amounts of free cash flow from this $10 upfront fee on the legacy classic FICO score, they are fundamentally altering how they monetize their next-generation intellectual property.
Right, the new stuff.
Yeah. FICO is currently rolling out a new scoring model called FICO Score 10T, and they are moving away from that flat $10 fee for it.
They are.
They are shifting to a strategy they call value-based pricing, and the mechanics of this are really fascinating.
This represents a major strategic inflection point for the company. FICO is effectively using the immense cash flow generated by the classic FICO price hikes to subsidize and distribute their newest intellectual property, Score 10T.
Right.
And they're doing it in a way that embeds them even deeper into the life cycle of a loan.
Okay, here's where it gets really interesting.
Yeah, during the earnings call, FICO's CEO, Will Lansing, spent significant time laying out the philosophy behind this shift.
What did he say?
He noted that historically, FICO charged a single, concentrated upfront fee to the initial mortgage originator.
Right, the guy pulling the credit report at the very beginning.
Exactly. Because of this structural setup, Lansing argued that a vast majority of the downstream beneficiaries of FICO's intellectual property were essentially getting a free ride.
A free ride.
Yeah, they were utilizing the predictive power of the FICO score without directly paying FICO for it.
Let's break that down for the listener, because the secondary mortgage market can be incredibly opaque. Who exactly are these downstream beneficiaries that are getting a free ride off FICO's math?
Sure, think about the life cycle of a standard 30-year fixed mortgage that ultimately gets securitized.
Okay.
The FICO score is initially pulled by the mortgage broker or originator to decide if the borrower is approved. That is step one.
They pay the $10.
Right. But then that exact same score travels with the loan file.
Like a passport.
Yes. It is used by the government-sponsored enterprises,
Mm-hmm.
the GSEs like Fannie Mae or Freddie Mac, to guarantee the loan.
Okay.
Then the loan is bundled into a mortgage-backed security.
An MBS.
Right. And that same FICO score is used by Wall Street quantitative analysts to price the risk of the entire bond.
Oh, wow.
Then it is used by the mortgage servicer who actually manages the monthly payments over the next 30 years to predict default probability.
So the immense value of that single mathematically precise credit score ripples through a multi-trillion-dollar secondary market.
Exactly. But historically, FICO only got paid a few bucks up front by the initial broker.
Wow.
Lansing's fundamental argument is that the economic value FICO provides is distributed across the entire lending chain, and therefore FICO's monetization should be distributed across the entire chain as well.
That makes perfect logical sense from a corporate strategy perspective. But how are they actually executing this new math? Because the structure they've designed for Score 10T is radically different from just, slapping a higher price tag on the front end.
It is. They have introduced a structure called the performance model.
Okay.
And this operates under their newly launched FICO Mortgage Direct License program. Under this performance model, the initial upfront fee for pulling a FICO Score 10T is remarkably low.
How low?
It is priced at just 99 cents.
99 cents.
Yeah.
That is a massive, deliberate drop from the $10 they were charging for the classic score.
Exactly. It is almost free. But there's a very strategic catch. If, and only if, that specific mortgage application actually closes and the loan is funded, FICO charges an additional $65 back-end funding fee.
Ah, so they're transforming from a simple data vendor into a true transaction partner.
Yes.
They're basically taking a royalty on the success of the actual mortgage.
That's exactly what it is.
But let's look at this from the perspective of, like, a mortgage broker sitting at their desk in Des Moines. Why does this model appeal to them?
That's a good question.
Why does FICO want to take 99 cents up front when they know they have the monopoly power to just demand $10?
Well, it solves one of the biggest psychological and financial pain points for mortgage originators, which is the cost of breakage.
Breakage. Okay, explain that.
In the real world of mortgage lending, an originator might pull credit scores for 10 different prospective homebuyers.
Just feeling out their credit.
Right. But maybe only one of those applicants actually makes it all the way to a closed funded mortgage. The other 9 fall through.
Because they get outbid on a house, or they decide to wait for lower rates, or maybe they just go with a competing lender.
Exactly. If the originator's paying $10 every single time they pull a score, they just burn $90 on dead leads.
Right, they're paying for failure.
By dropping the upfront cost to 99 cents, FICO radically reduces that upfront breakage cost.
The psychological relief for the loan officer has to be immense.
It really is.
It completely removes the friction. If I'm a broker, I don't even have to hesitate before pulling a 10T score. I'm not burning cash on tire kickers.
Exactly.
FICO is essentially saying, sure, look around for a buck, and if you actually make money on this deal, we'll settle up at the closing table.
Precisely. That frictionless entry point is heavily engineered to encourage massive, rapid early adoption of Score 10T.
They just want it everywhere.
They want every single lender in the country integrating 10T into their underwriting software immediately. And once that loan finally closes, that $65 back-end fee is just easily absorbed into the thousands of dollars of standard closing costs.
The consumer barely notices it.
Right. The lender doesn't mind because they only pay it when they secure a revenue-generating loan.
And FICO suddenly captures $65.99 of total economic value instead of $10.
It is a brilliant mechanism to expand their total addressable market while aligning their pricing with actual lender success.
Okay, so the monetization strategy is absolutely brilliant, but let's look at the actual product itself, because you can't charge $65 for a product if it isn't objectively better than the old one.
No, you can't.
Why is FICO pushing Score 10T so hard? What makes it mathematically superior to the classic FICO score that the entire industry has relied on for 3 decades?
Well, the competitive advantage of 10T lies entirely in its advanced data architecture.
Okay.
The single biggest difference is that 10T incorporates a concept known as trended data.
Trended data. I see that term all over the memos. Contrast that for me. As opposed to what? What is the old way?
The old way, the classic FICO score, relies on snapshot data. Right. It looks at your credit profile at a very specific frozen moment in time. It asks, what is your credit card balance today? Have you missed a payment in the last 30 days?
It's just a photograph.
Exactly, it's a photograph.
Yeah.
Trended data, on the other hand, is a high-definition video.
Okay, I like that.
It evaluates your financial behavior over a continuous 24-month historical period.
Oh, wow, 2 full years.
Yes. It asks, are you consistently paying down your principal balances every month, or are you just making the minimum payments while slowly creeping your utilization higher and higher?
Right, because both of those people might have the exact same balance today, but one is heading towards 0 and one is heading towards default.
Precisely. It understands the trajectory of your debt, not just the current volume of it.
That's huge.
And on top of that 24-month trajectory, 10T brings in massive streams of alternative data that were never traditionally weighed in mortgage underwriting.
Like what?
Specifically, it looks at historical rental payments, utility payments, and telco data, like your cell phone bill history.
That is a massive paradigm shift.
It really is.
So if we look at a hypothetical borrower, let's say a 25-year-old who has never had a car loan and actively avoids using credit cards because they are, debt averse.
Right. Very common.
Under the old snapshot model, they have what the industry calls a thin file. They look completely risky because they basically have no data.
Exactly.
But if they have paid their rent and their Verizon bill perfectly on time every single month for 5 years, 10T actually sees that discipline and rewards them for it.
Exactly. And strategically, that is a masterstroke by FICO
Why is that?
because it directly neutralizes one of the most potent political and regulatory arguments that competitors have wielded against them for years.
The inclusivity argument.
Right. Critics have argued forever that legacy FICO models are inherently exclusionary.
That they structurally lock out younger consumers, immigrants, marginalized communities, people who operate heavily in cash and just have thin traditional credit files.
Yes. By incorporating this trended and alternative data, 10T drastically expands the pool of mathematically qualified borrowers. The source materials heavily emphasize that this is profoundly impactful for first-time homebuyers.
Which, not coincidentally, is exactly the demographic the federal government and the FHFA desperately want to stimulate right now.
Exactly.
They want to boost homeownership rates among younger generations. So FICO is basically aligning its product with macroeconomic policy goals.
That's a great way to put it.
But there has to be a catch. I mean, if you just expand the pool and let everyone in, default rates should theoretically skyrocket, right? You're bringing in riskier people.
And this is the dual benefit that makes 10T such a formidable underwriting tool.
Okay.
It is not just artificially inflating credit scores to appear more inclusive for PR purposes. It is actually generating a more mathematically precise assessment of risk.
Show me the numbers on that.
According to FICO's internal data and their early market testing, by evaluating this expanded, trended dataset, Score 10T achieves two things simultaneously. First, it generates a 5% overall increase in approval volumes.
Meaning more people get homes, which the lenders absolutely love.
Exactly. But second, and more importantly for the risk managers, it simultaneously identifies 18% more hidden defaulters than the older models.
Wait, really? 18%?
Yes.
That is an incredible statistical divergence. So they are increasing the top of the funnel, approving more loans, and generating more revenue for the banks, while simultaneously filtering out the hidden risks that the snapshot model totally missed.
It is the holy grail for a lender. You get higher volume, but lower risk.
That is wild. It makes the scoring system demonstrably more inclusive while simultaneously making it more predictive.
Yes. And the institutional market is already responding to that dual benefit.
How so? Are they actually using it yet?
Well, while FICO is technically waiting for the federal regulators to fully mandate the release of historical 10T data for broad secondary market testing, they haven't just been sitting on their hands.
Right.
They proactively launched an early adopter program to get the software into the wild.
How does that early adopter program actually function on the ground? Like, what are the mechanics?
They essentially give originators access to 10T for free, or at an incredibly subsidized rate, to run alongside their standard classic FICO pools.
Just to test drive it.
Exactly. And the adoption metrics are highly encouraging. The program currently boasts 55 participating lenders, representing over $495 billion in eligible mortgage originations.
Wow. $500 billion.
Right. But what is really telling is the behavior in the non-conforming market.
The jumbo loans.
Yes. These are the massive mortgages that exceed the limits of what Fannie Mae and Freddie Mac will guarantee.
Right, so the government isn't backing those.
Exactly. Because lenders hold these massive loans on their own balance sheets, they care deeply about precise risk.
They're on the hook if it fails.
Right. And in that non-conforming space, lenders are already actively pulling 10T in parallel with classic FICO to underwrite their risk today.
They aren't waiting for a federal mandate.
No. They recognize the superior data architecture, and they want it protecting their capital now.
Okay, so let's summarize the board state here.
Let's do it.
FICO has this incredible monopoly pricing power generating massive free cash flow. They have engineered a technologically superior new product in 10T. They've created a frictionless value-based pricing model to ensure adoption. It sounds like a flawless, inevitable victory.
It does sound like that.
But as we established earlier, a toll bridge that keeps aggressively raising its prices and restructuring its toll system will inevitably attract the ire of the local authorities.
It always does.
For FICO, the local authorities are the federal regulators, and those regulators are actively bringing a massive existential threat to the gates.
This is the primary bear case, and it is the central risk to the entire FICO investment thesis.
Let's get into it.
The regulatory spotlight currently aimed at FICO is glaring, and it is honestly quite hostile.
I mean, when a corporation doubles the price of a service that is legally or structurally essential to buying a home in America, you generate immediate severe reputational risk.
Absolutely. In mortgage industry circles, FICO's aggressive pricing strategy has led to the company being openly labeled as a tax on the American financial system.
Yikes. That specific phrasing is dangerous.
Very dangerous. When a private corporation is viewed by the government as an unelected tax collector rather than an innovative service provider, it draws immense punitive scrutiny.
Yeah, that's when the big guns come out.
We are talking about deep structural attention from the FHFA, the Federal Housing Finance Agency.
Which oversees the entire conforming mortgage market.
Right. And there are even antitrust rumblings from the Department of Justice.
And the regulators aren't just, sending angry letters or holding congressional hearings. They are actively funding, approving, and mandating a direct competitor to break FICO's monopoly.
Yes. Enter VantageScore 4.0.
Let's talk about VantageScore, because they aren't just some scrappy startup in a garage, right?
Not at all. VantageScore is a credit scoring model created collaboratively by the three major credit bureaus themselves.
Equifax, Experian, and TransUnion.
Exactly. So they have massive, massive data resources.
Right.
And the critical development here is that the FHFA has officially approved a pilot program allowing 21 major lenders to begin using VantageScore 4.0 in the conforming mortgage market.
Wow.
This is a direct, federally mandated attempt to introduce viable competition and break FICO's absolute stranglehold on the U.S. housing market.
Now, I want to play devil's advocate here for a second,
Okay.
because when I look at the mechanics of a dual score system, I see a massive vulnerability.
What do you mean?
Let's say the GSEs, Fannie and Freddie, look at this pilot program and decide to permanently accept a dual score system.
Okay.
They tell the market, okay, lenders, you can send us a traditional FICO score, or you can send us a VantageScore. We will accept either one to guarantee the mortgage.
Right. Giving them the choice.
If I am a smart mortgage originator, why wouldn't I just pull both scores for every single applicant, look at which algorithm spits out a higher number, and simply submit that one? Because a better credit score means better pricing on the GSE's loan-level price adjustment grids, the LLPA grids.
Yes. Let's briefly explain the LLPA grids for the listener, because that is the exact mechanism of the vulnerability you're talking about.
Go for it.
Fannie Mae and Freddie Mac charge fees to lenders based on the perceived risk of the loan.
Right.
And they use a literal grid. On one axis is your down payment percentage, and on the other axis is your credit score.
Yeah.
If your score is 740, you pay a certain fee. If your score is 780, that fee drops significantly.
Right. So a higher score literally equals a cheaper mortgage for my client.
Exactly.
If I can game the system by picking VantageScore whenever it happens to rate my borrower higher than FICO does, I can offer my client a cheaper rate than the broker down the street.
You absolutely could.
So if lenders can structurally game the system for a discount, isn't that an existential threat to FICO? Won't lenders just slowly abandon FICO whenever VantageScore provides a competitive advantage?
It is a profound threat. And management openly acknowledges that in a federally mandated two-score system, market gaming is not just possible, it is structurally inevitable.
Because lenders have a fiduciary duty to get their clients the best rate.
Exactly. But FICO hasn't been sitting idle.
I would hope not.
No, what's fascinating here is how FICO has strategically neutralized VantageScore. They have built a highly strategic, three-pronged defense that is designed to completely neutralize that threat before it scales.
I love a good corporate defense strategy. Let's hear it. How do you defend your monopoly against a federally mandated competitor?
Defense number one is absolute price parity.
Okay.
Remember that 99-cent upfront cost for the 10T performance model we just analyzed?
Yeah, the low-friction entry point.
That was not a randomly selected number. It turns out VantageScore's upfront cost to the lender is also roughly 99 cents.
Oh, wow.
Yeah. By strategically dropping 10T's upfront cost to 99 cents, FICO instantly achieved perfect price parity on the front end.
They just matched them to the penny.
Exactly. They completely eliminated any upfront cost savings a lender might achieve by choosing VantageScore. If they both cost $1 to pull, you completely neutralize price as a competitive wedge.
Okay, that is a brilliant tactical block.
Wow.
You remove the immediate financial incentive to switch. But price parity is only half the battle, right?
Right.
If a massive originator is holding $100 million in bundled mortgages that they want to sell to Wall Street investors, a cheap upfront score doesn't matter at all if Wall Street doesn't trust the underlying math of the loans.
Exactly. Which brings us to the data itself.
Right. What is defense number 2?
Defense number 2 is full cycle testing and predictiveness. This is where FICO aggressively leverages its 35-year legacy.
Okay, flex the history.
During the earnings call, FICO's executive management repeatedly pointed out a massive structural vulnerability in the VantageScore model.
Which is?
VantageScore's historical data only goes back to 2013.
Wait, 2013? That is a massive red flag. That means the VantageScore algorithms have never actually seen a true systemic housing crisis. They completely missed the 2008 Great Financial Crisis.
Precisely.
Wow.
They have only ever existed in a macro environment characterized by zero interest rates and quantitative easing. They have never been mathematically tested through a full, severe economic cycle.
That's a terrifying thought from an investor.
It is. FICO argues forcefully that this lack of historical data creates massive unknown systemic risks. If you are an institutional investor buying $1 billion worth of mortgage-backed securities, you demand to know exactly how those loans will perform in a deep recession.
You need to model the credit default risk and the prepayment velocity under extreme stress.
Exactly. FICO's models have 35 years of known mathematically predictable performance. They have navigated dot-com crashes, the Great Financial Crisis, and the pandemic shock.
They've seen it all.
Right. VantageScore simply does not have that resume. So FICO is effectively telling the secondary market, and by extension the regulators, if you force this system to switch to this cheaper, untested model, you are blindly introducing massive systemic risk into the foundation of the U.S. housing market.
That is a very heavy, very effective counter-argument.
It really is.
It is essentially saying, sure, use the other guy if you want to fly blind into the next recession. That argument resonates deeply with institutional risk managers.
It does.
And what is the third pillar of their defense?
The third pillar is highlighting cold market reality.
Okay.
There is a massive amount of PR noise and lobbying about VantageScore taking over the market. But FICO looks at the actual operational numbers.
What do the numbers say?
FICO estimates that VantageScore's actual paid market share, meaning credit scores that institutional lenders are actively choosing to pay for and use to underwrite real capital risk, is a trivial 2% across all credit products.
2%.
Yeah. And in the non-conforming mortgage market, the jumbo loan sector where lenders currently have free choice and aren't bound by GSE mandates, VantageScore has absolutely zero presence. None.
So all the headlines are just noise?
Pretty much. FICO claims that the massive volumes VantageScore reports in their press releases are mostly comprised of scores that the credit bureaus are just giving away for free to consumers on credit monitoring apps.
Oh, like when I log into my credit card app and says, here's your free score?
Exactly. They aren't scores being used for serious institutional lending.
So FICO's posture is essentially, we match their upfront price, our data architecture is historically safer and battle-tested, and by the way, nobody who manages real capital actually pays for their product anyway.
It is an incredibly confident, almost dismissive posture.
It really is. But, I want to zoom out for a second and look at the broader corporate structure here.
Okay.
Because if FICO's scoring business is this incredible cash cow fighting off regulatory wolves while still generating unprecedented inelastic revenue, what are they actually doing with all this money?
That is the big question.
Because a corporation cannot just sit on a mountain of cash forever. They have to deploy it. They have to invest in the future.
Right.
And this is where the narrative shifts dramatically from a story about a legacy data monopoly to something much more modern. FICO is actively rebuilding itself into a cloud-native software giant.
This is the second engine of the FICO investment thesis, and it is arguably the most important element for their long-term valuation multiple.
Let's get into the software.
Beyond the scores, FICO operates a massive software segment. In Q2 2026, that software segment generated an annual recurring revenue, or ARR, of $789 million.
Nearly $800 million. That's a huge SaaS business just on its own.
It is. But to understand what is really happening inside this company, we have to deeply analyze that number because there is a massive structural divergence occurring inside that software division.
Yeah, when I first looked at that software segment ARR of $789 million in the earnings report, I saw a divergence that initially terrified me.
The legacy decay.
Yes. You've got this legacy non-platform software business that is actively shrinking. It's down 8% year over year to 440 million.
Right.
And it is carrying a terrible net retention rate of just 90%.
Which is very bad in the software world.
Terrible. That means they are bleeding 10% of that legacy recurring revenue every single year to churn, end-of-life product shutdowns, and declining usage.
Yep.
If I stop reading the report right there, I'm panicking. But the stock is up. Wall Street seems entirely unfazed by the decay of the legacy business. What is the mechanism driving the optimism?
Well, Wall Street is entirely ignoring the 8% legacy decline because of what is happening on the exact opposite side of the software ledger.
The platform.
Exactly. While the legacy on-premise business is slowly bleeding out, their new cloud-native FICO platform ARR exploded by 49% year over year.
49%.
Reaching $349 million. The street is absolutely obsessed with this specific metric.
Why are they so obsessed with it?
Because that 49% growth isn't just driven by expensive new customer acquisition. It is driven by an incredible 136% platform net retention rate.
Okay, let's pause and define that for the listener, because 136% NRR is literally the holy grail of SaaS economics.
It really is.
For those not steeped in software metrics, net retention rate measures the revenue growth of an existing cohort of customers.
Right.
So if FICO signed a group of banks to the platform last year and those banks paid $100 in subscription fees, 136% NRR means that exact same group of banks is paying FICO $136 this year.
Exactly. And they are doing that without FICO having to spend a single dime on new sales and marketing to acquire them.
Right. The customers are just organically using the product 36% more.
That fundamentally transforms the lifetime value to customer acquisition cost ratio.
It's basically an infinite money printer if you can sustain it. So how are they physically executing that kind of expansion inside these massive, slow-moving banks?
They are executing a textbook, flawless land and expand strategy.
Walk us through that.
Here is the operational reality. A massive global bank, think a JP Morgan or a Citi, doesn't just wake up one morning and decide to rip out its entire legacy infrastructure and migrate its entire operation to a new cloud platform.
No, the operational risk is way too high. They'd never do it.
Right. So FICO starts small. They approach the bank and say, let's just migrate one specific, highly critical use case to the FICO platform.
Like a Trojan horse.
Basically. Let's say real-time fraud detection on consumer credit cards.
Okay, they land the initial contract, they get their foot in the door.
Exactly, they land. But once the FICO platform is installed inside the bank's architecture, the inherent logic of the software takes over.
How so?
Well, historically, global banks have operated with deeply fragmented, siloed data.
Oh, totally. The departments never talk to each other.
Exactly. The fraud department sees one specific version of the customer. The mortgage originations department sees a completely different version, and the marketing department sees a third. They don't talk to each other in real time.
Right.
The FICO platform acts as a unified, real-time intelligence layer. It breaks down the silos.
Ah. So the bank's chief information officer suddenly realizes, wait, if we plug our auto loan origination data into this exact same FICO platform, it can instantly talk to the fraud data we already migrated.
Yes. The bank discovers the massive compounding value of connected decisions.
Right, because if you know a guy is committing credit card fraud, you probably don't want to give him an auto loan either.
Exactly. Every time the bank adds a new risk model or a new operational use case to the platform, the underlying algorithmic profile of the customer gets smarter, faster, and more predictive.
It's a network effect inside the bank itself.
Yes. So the bank organically starts migrating more and more processes. First, it was just fraud. Then they move over credit card originations.
Then customer lifecycle management.
Then early-stage collections. And eventually, over a few years, the bank migrates its entire mission-critical decision-making engine to the FICO cloud.
Wow. That represents a fundamental, irreversible shift in the corporate relationship.
It really does.
FICO stops being just a third-party vendor who provides a final 3-digit score at the end of the loan pipeline. They become the underlying operating system of the bank itself.
They own the cognitive logic of the institution.
And once a global bank builds its core operations on your proprietary cloud platform, the switching costs become effectively insurmountable.
You're practically married to them for decades.
Which brings us to the most critical technological question of this entire analysis, I think.
What's that?
If FICO is building this incredibly powerful, centralized, AI-driven operating system for global banks, how do they actually defend it?
Right, the moat.
Yeah, because we are living in the golden age of artificial intelligence disruptors.
Hmm.
Nimble, venture-backed fintech startups are popping up every single day, armed with billions in Silicon Valley capital, claiming they have faster, cheaper, better AI models.
Everyone claims they have the ultimate large language model now.
Right. So how does a 7-year-old company like FICO prove their technological moat is actually real and defensible? What is stopping a massive tech giant or a well-funded startup from just training a proprietary LLM on financial data, walking into a bank, and undercutting FICO's platform pricing?
It's a great question. And the answer is that in the highly regulated, politically sensitive world of global financial services, the Silicon Valley mantra of move fast and break things will get you immediately sued by the federal government.
And shut down by the CFPB.
Exactly. Most of these new fintech startups utilize what is known as black box AI.
Okay, define black box for us.
A black box deep learning model might be incredibly fast, and it might even be statistically highly accurate in predicting default risk. But it has a fatal flaw.
Which is?
It cannot mathematically explain how it arrived at its decision. The algorithm's neural network is simply too opaque.
It's just a magic 8-ball that spits out an answer.
Exactly. And federal regulators absolutely hate black box AI.
Let's explore that from the regulator's perspective for a second. If the AI model successfully predicts risk and saves the bank money, why does the government actually care how it did it?
Because of strict federal fair lending laws, specifically the Equal Credit Opportunity Act.
Right.
Imagine a scenario where a bank uses a startup's black box AI to evaluate mortgage applications. The AI denies a loan to a minority applicant.
Okay.
The applicant files a discrimination complaint. By law, the bank must be able to prove, mathematically and legally, that the denial was based purely on objective financial risk factors, like a high debt-to-income ratio.
And not on some hidden algorithmic proxy for race, gender, or geography.
Right. This is known as proxy redlining.
Proxy redlining.
Yeah. If the AI is a black box, the bank literally cannot explain to the regulators why the AI denied the loan. They cannot produce an auditable trail of logic.
Because even the engineers who build the AI don't fully understand how the neural network weighted the variables.
Exactly. Therefore, the bank simply cannot use the software. The compliance risk is infinite.
So in the banking sector, explainability is not just a premium feature on a pricing tier. It is a hard legal requirement for doing business.
It is an absolute non-negotiable requirement for the chief compliance officer of any regulated institution.
Right.
And this is precisely where FICO's intellectual property moat becomes practically impenetrable. The FICO platform is engineered to be what they call agentic by design.
Let's pause on agentic because that is a massive buzzword right now, but here it has a very specific literal meaning.
It does.
Traditional software waits for a human operator to pull a lever or approve a flag. Agentic AI acts as an autonomous agent.
Exactly.
If the FICO platform detects a massive anomaly in a credit profile, it doesn't just send an email alert to a risk manager. It autonomously quarantines the application, cross-references it with alternative telco data, and adjusts the risk parameter in real time without human intervention.
Yes. It operationalizes high-speed AI at a massive scale, but crucially, it does so safely and transparently.
How do they guarantee the transparency?
FICO holds over 200 patents, and crucially, 137 of those are specifically focused on artificial intelligence.
Wow. 137 AI patents.
Yes, and these are not generic software patents. They specifically protect technologies related to traceable, ethical, and explainable AI decisioning.
They actually patented the explainability.
They did. They even hold patents for utilizing blockchain technology to create permanent, auditable trails of exactly how and why an AI agent made a specific lending decision.
That is wild. So FICO has taken their 70 years of domain expertise in credit risk, their deep understanding of consumer behavior, and essentially encoded it into these autonomous AI agents.
Exactly right.
They wrapped those agents in a patented fortress of legal and regulatory compliance and handed them to the banks.
That's the business model.
They are effectively walking into a JP Morgan and saying, we have the only autonomous AI operating system that is guaranteed not to get you investigated by the CFPB.
Precisely. A Silicon Valley startup might have a slightly faster algorithm this week, but they absolutely do not have 70 years of proprietary historical data from the Falcon Consortium, which tracks billions of actual financial transactions across 9,000 global financial institutions.
No startup has that.
Right. They do not hold the patents for ethical, explainable AI. And most importantly, They do not have the institutional trust of the compliance officers at the top 50 global banks.
The trust factor is huge.
It is everything. That unique combination of exclusive historical data, patented algorithmic explainability, and deep enterprise trust creates a defensive moat that is almost impossible for a disruptor to cross, no matter how much venture capital they have.
Okay, we've covered an immense amount of ground here.
We really have.
We have established their inelastic monopoly pricing power in the Scores business, which
Yeah.
is generating immense predictable cash.
Yeah.
And we have analyzed the hypergrowth SaaS platform that is successfully building an insurmountable operational moat around the world's largest banks. Now, we need to bring this analysis to its logical conclusion. How does this massive corporate pivot translate into a concrete investment roadmap for the listener?
This is where it all comes together.
FICO is sitting on a mountain of cash. The financial press releases indicate they generated a staggering $867 million in trailing 12-month free cash flow.
It's a lot of cash.
That is an absurd amount of capital for a company with such low physical capital expenditures. I mean, they don't have to build massive manufacturing plants or manage global supply chains. They write code and manage data.
Exactly.
What exactly is FICO's executive management doing with almost $1 billion in free cash flow?
They are executing an absolute masterclass in financial engineering and aggressive capital return.
Okay, tell me about the financial engineering.
They are funneling almost all of that free cash flow into relentless, systematic share buybacks.
Oh, wow.
If you look at Q2 2026 alone, FICO executed its largest quarterly stock repurchase in the history of the company.
Really? Just this past quarter?
Yes. They spent $605 million in a single 90-day period.
Unbelievable.
And they used that to retire 484,000 shares at an average price of $12,251 per share.
$600 million in one quarter. That isn't just a standard corporate buyback program to, offset stock-based compensation for executives.
No, not at all.
That is aggressive, deliberate financial engineering.
It is the systemic, calculated cannibalism of their own publicly traded shares.
Cannibalism, I like that.
Yeah. FICO operates a very unique, highly leverageable business model. They operate at a massive 65% non-GAAP operating margin.
Because it's just software and data.
Exactly. As you mentioned, they require very little reinvestment capital to grow their core business. Because of this structural efficiency, they have the cash flow to systematically retire roughly 3% to 5% of their total outstanding market capitalization every single year, like clockwork.
Let's walk through the actual math on that for the listener, because it is the key to their valuation premium. Why does systematically shrinking the share count by 5% a year matter so much to an institutional investor?
It comes down to the fundamental metric of Wall Street, which is earnings per share, or EPS.
Right.
EPS is simply the company's total net profit divided by the total number of outstanding shares.
Simple division.
Right. If FICO's actual absolute net profit stays perfectly flat for an entire year, let's say macroeconomic conditions are terrible and revenue stalls entirely.
Okay, a flat year.
But they use their cash reserves to retire 5% of their total shares. Their reported EPS still organically grows by 5%.
Ah, because the denominator got smaller.
Exactly. They are artificially engineering continuous earnings growth through the buybacks. It places a massive structural floor under their EPS trajectory.
So even if things go badly in the broader economy, their numbers still look good.
Yes. Even if we enter a modest macroeconomic recession, housing stalls, and their top-line revenue slows down, their EPS will likely still expand because the denominator in the equation, the share count, is constantly, relentlessly shrinking.
It is a brilliant, self-funding growth machine.
It really is.
The monopoly cash from the legacy Scores business funds, the massive share buybacks. The buybacks artificially drive the EPS higher. The higher EPS drives the stock price up, which rewards the executives and the shareholders.
That's the cycle.
And on top of all this financial engineering, the underlying business is actually accelerating. They actually raised their forward guidance in this latest report, didn't they?
Yes, they did, which is a massive signal of confidence.
What are the new numbers?
Management officially updated their fiscal year 2026 outlook. They raised their total revenue projection to $2.45 billion. Huge. And crucially, they raised their non-GAAP EPS guidance to $40.45.
Wow. This is not the financial profile of a company bracing for regulatory impact or economic slowdown.
No.
This is the profile of a company hitting the accelerator.
Absolutely.
So we arrive at the final verdict. Based on the strategic investment memos in our source stack, the analysts are overwhelmingly rating FICO as a BUY.
They are.
But they are using a very specific phrase that I want to unpack. They are calling this a vertical sauce re-rating. What does that mean in practical Wall Street terms?
This is the crux of the entire investment thesis.
Okay.
If we connect all of these disparate data points to the broader macroeconomic picture, a re-rating means the institutional market has realized it fundamentally mispriced the true nature of FICO's business model.
Oh, I see.
For decades, FICO was valued simply as a slow-growth legacy data provider. Data providers typically trade at moderate conservative price-to-earnings multiples.
Because they're boring.
Right, they're boring. But vertical sauce companies, cloud software platforms that utterly dominate a specific industry vertical, like Aviva in healthcare or a Procore in construction, they trade at massive premium valuation multiples.
Sky-high valuation.
Yeah, exactly. They trade at a premium because of their high gross margins, their extreme net retention rates, and the predictability of their recurring revenue.
So the overarching thesis here is that FICO is currently in the middle of a valuation transition. They are shedding the boring, moderate data provider multiple, and they are expanding into a high-growth premium software multiple purely based on the success of that 136% NRR platform.
Exactly. And the most beautiful, structurally sound part of this transition for an investor is that this massive corporate pivot, which for most companies would be incredibly high risk and require billions in debt, is being entirely underwritten, entirely funded by their absolute monopoly pricing power in the B2B Scores business.
They literally have a legacy cash cow acting as the financial booster rocket for a next-generation SaaS platform.
It's an incredible setup.
It is a remarkable, almost unprecedented corporate evolution. I mean, they are playing three-dimensional chess with pricing power, AI patents, and share buybacks, while their legacy competitors are still fighting over incremental data points.
They're just operating on a completely different level.
But as we wrap up this deep dive into FICO's architecture, I want to leave you, the listener, with a final, slightly provocative thought.
Oh, this is a good one.
Something to deeply mull over that wasn't explicitly spelled out in the earnings calls or the pristine investor presentations, but is the undeniable logical conclusion of everything we have discussed today.
Let's hear it.
Let's consider the ultimate endgame of this strategy. Based on the data, FICO is rapidly succeeding in becoming the underlying agentic AI operating system for the world's largest banks.
Right. They own the complex software logic that makes the actual financial decisions.
Yes. At the exact same time, through the massive rollout of FICO Score 10T, they are cementing their historical role as the definitive gatekeeper for the consumer, holding the proprietary data that determines exactly who gets access to capital and who does not.
So they control both sides.
Exactly. If a single corporation controls the autonomous brain of the bank and simultaneously controls the key to the consumer, does FICO eventually hold more systemic power over the flow of capital in the American economy than the major global banks themselves?
That is a staggering thought.
It is a chilling but deeply fascinating question. When the analytical tool outgrows the user, who is really in charge of the financial system, a simple three-digit number, or the autonomous AI platform operating silently behind it, think about the implications of that the next time you sit down to apply for a mortgage. Risk defined, portfolio protected.